Recessions are the best time to become rich, and apparently the current situation is becoming a once-in-a-generation opportunity to multiply your wealth many folds. Because in bad times, the rich usually get richer. An anonymous saying is that riches are made in recession. And if you look at today's economic situation, it seems obvious that a similar opportunity is knocking on the door again. But remember, the opportunities don't last forever. So, let's look into the story of the day. Let's have a look at these recent headlines. You'll find that 9 out of 10 CEOs are preparing for a recession. All of the CFOs are cutting costs by 10%, while JP Morgan is warning that the stock market may fall a further 20% from its current levels. Now, although it sounds negative and depressing, in fact, recessions happen periodically. If we use the scenario correctly, we can be set up for the rest of our lives grabbing incredible opportunities and discounts. The legendary Warren Buffett once said that the bad news is an investor's best friend. So let's talk about what's expected to happen in the next 12 to 24 months. Usually, recessions come with a significant rise in unemployment, a decrease in wages, a loss of consumer confidence, and a decline in the value of almost everything from stocks, energy, food, and services, with certain effects staying down for the long term around the globe. Secondly, recessions push corporate earnings down. Now, in recent quarterly earnings, slow or negative growth can be seen. The squeezed earnings and employment shrinkage further multiply the impact and trigger layoffs on a broader scale. The cumulative impact brings a massive reduction in aggregate demand, and it can be seen that dozens and dozens of companies have been laying off their workforce. Bank of America warned that the U.S. will be experiencing about 175,000 jobs lost each month. So what does all this mean for your investment? And how can this information be used to make money? Let us begin with stocks. All 3 major indices have dropped up to 30% year to date. According to the analysis of JP Morgan, these are supposed to drop a further 20% from their current value. Historically, since 1946, we can conclude that maximum bearish values were 30%. The most severe was in the fall of 2009. It was when S&P fell 57% from its peak. On combining the average with the recession, these bear markets dropped very low to a level of 34.8% on average, and right now markets are down around 25%. It's usually said that the absolute bottom is hit when we see investors retreating everywhere. This is exactly the point where things start to bounce back and time to recover. Let's talk about real estate. It is a fact that every area is different, and some locations may continue to have flourishing housing. However, declines on a national level are very rare to be seen. In the last 60 years, there have been very few times when we saw prices fall significantly more than 10%. Now, according to the Wall Street consensus, national housing prices will decline to 7%, and the worst decline will be 10 to 15%. In case interest rates continue to rise, every market will react differently. According to Moody's, the most vulnerable markets may see a 25% decline from its peak. This includes parts of Idaho, Florida, Arizona, and Southern California, where this decline tends to survive for a year and a half approximately before bottoming out. This will not have any big difference for the people having fixed mortgages and planning to stay in their properties for the next 5 to 10 years. On the other hand, if someone wants to invest in property, well, then we must expect to see certain deals, which we'll discuss in a moment. The third aspect is cash. The normal mindset is that cash is nothing but to waste away in inflation. However, when the prices of assets are falling, then cash could always be the safest place to store one's wealth. The statement becomes significant when a billionaire like Ray Dalio agrees that cash is not trash anymore. People might have forgotten, but recently in 2018, cash had been the most performing asset. Had you been saving your money in savings accounts, providing you with high yield, you would have beaten the market. Cash is no doubt becoming one of the important parts of a portfolio. We see fund managers holding on to the highest cash amount since 2001. Similarly, Citigroup has stated that cash is the only thing investors can use as a recession hatch. So what can you do about all this to make money? And why do people usually fail to take advantage of what's around the corner? The following is what you need to know. The first thing about how a recession can be a once-in-a-generation opportunity to grow wealth is that everything will be less expensive. When a person would think that this is not the right time to invest when everything's falling around 30%, a wealthy person would see an opportunity to buy everything at a 30% discount. Warren Buffett has shared the perfect analogy of that. He said, "When hamburger prices go down, we sing, and when it goes up, we cry." People think the same about everything in life except stock. When stocks go down, one can get more for their money. However, people don't like them anymore. Hence, you need to reframe your mind that even a falling market can be advantageous for you. The second thing is less competition. During difficult times, companies scale back their expenses to preserve cash and play safe. On the other hand, it opens doors for smaller yet aggressive companies to come forward and take their place. A study showed that among 16,000 companies, the ones that kept advertising enhanced their wealth and got bigger with positive growth at the end of the recession. The third is more opportunity. Somehow, the recession is a market's way to weed out the weak ones and give opportunities to new, smaller businesses and people to develop. Patrick and David made a perfect comparison several months ago. It is that the peak of any market is like a forest where only the highest trees get the sunlight. As in our markets, this means only established companies get access to resources. But just like a forest catches fire, our economies have a way of bankrupting the giants who can't sustain themselves anymore and give chances to the smaller businesses to continue to flourish and develop. Fourth is that after every bear market is a bull market. Yahoo has pointed out that the S&P 500 has fallen to an average of 29% around a recession. However, the stock that touched its lowest returned at 40% the following year, and in a couple years it was 58%. This implies that investing when things are going down is more profitable than pulling out. Waiting in the long term, markets always recover. It has been witnessed throughout history. Fifth is that you have to act before anyone else knows. It's easier said than done. It seems okay to invest in recessions. However, recessions are never confirmed. For instance, the Great Recession of 2007 was not announced until December of 2008. We always find the recession when it's about to end. So, what can we do? First, you should keep track of your market, cut unnecessary expenses, and operate lean. Also, continue reinvesting as much as possible back into the market. You should also have a backup plan on what you must do if you see your investment dropping from 20 to 50%, how you'll make up the difference, and if you can potentially make preventative measures ahead of all this happening. Second, you should hold on to some cash. One must have a firm belief that no doubt money is best used when it is invested. However, one has to have peace of mind when one has cash in hand. An investor always has 15 to 20% of his or her portfolio being made up of cash based on the time of the year. This enables investors to jump on to good opportunities. Third, you should protect your career. This is something that will prove to be your best hedge regardless of what happens. The worst scenario is not that the market goes down, but rather not only the market goes down and you lose your job at the same time and then have the investment sell off before there's time to recover. This is the best time to learn new skills and double whatever you have. For instance, a 5% allocation of Bitcoin may have boosted the return of a portfolio by 65% since 2014. Fourth, focus on investing long-term only. Usually, it's better not to invest any money that you need in the next 5 years. The best way while investing is not to do anything different, but carry on in the usual manner. As seen and observed, dollar cost averaging, or buying practices at regular intervals in the long term, is one of the most profitable investment strategies. Therefore, stay in the market and continue buying. And fifth, diversify your investments. If you're not capable of handling a 20% drop in price, well, then prices are that you've invested aggressively. For instance, if you've invested in US tech stocks, well, then you must try investing in real estate where rents seem to be more stable. In this way, your portfolio will have more to stand on and will be less likely to collapse. Hopefully you enjoyed our content. Leave a thumbs up to encourage more work, and we'll see you again with another video.